Hi everyone, I am Avadhoot. Now our next session is admission of partner. How the partner is admitted, whether it is admitted or not, and what are the procedures are there for the admission of partner in a existing partnership firm that we'll have to see, and how it is to be accounted for, what the accounts are to be prepared and how it is to be prepared, that we'll have to consider in this session. Therefore, our agenda for this section is what? First of all, introduction. Next one is ratios. Then goodwill and calculation of goodwill is there. Goodwill is actually big, but this chapter we are going to consider what is goodwill and the treatment of goodwill, how it is to be treated, and preparation of different accounts of the admission of partner. Let's start with the introduction. According to section 31 subsection 1 of the Partnership Act 1932, a person can be admitted as a new partner only with the consent of all existing partners unless otherwise agreed upon. New partner will bring his share of goodwill and capital and enjoy the right to share the future profits. Old partners have to sacrifice, obviously, their share of profit for new partner. Now, why the new partner is admitted? Obviously, the new partner is admitted only for the benefit gain of the partnership firm. That is, first of all, we can say for the expansion of capital. Am I right? For expansion of capital. Then by using a new partner can use his own skill, technique, his knowledge, etc. And he gives the improvement overall for the performance of a partnership firm. By that way, the partnership firm can earn a more and more profit, and that's why he is admitted in the partnership firm. Now, whenever a new partner comes in the partnership firm, what he brings? He brings his capital. The capital may be bought by two ways. Am I right? That is either by cash, that is bank, or in kind too. Now, kind means certain assets. Whenever a new partner brings a capital into the partnership firm, obviously your entry will be what comes in here? Cash comes in. Therefore, cash or bank account debit. If suppose assets brings, that is assets account debit, whatever he brings it, and is to be credited to new partner's capital account. You will have to write the narration as it is. The entry will be cash or bank account debit, asset account debit, whatever is there, or both are there, cash or bank account debit, asset account debit to new partner's capital account. Now, next part. Afterwards, when he brings all these things in the partnership firm, that entries will have to pass. Later on, whenever we are going to consider his entry in the partnership, automatically we are going to consider for the ratio. And that's why it is told that the old partners has to sacrifice, because previously there were two partners, and when a new partner enters in a partnership firm, we'll have to make the sacrifice. Ratio means what? That is profit sharing ratio that we have seen in our first section already. Now here in this section there are two ratios are there. One is your new ratio, new PSR, and you will have to consider what is your sacrifice ratio, that is SR, and here it is NR. As the new partner is admitted in partnership firm, the PSR of existing partners changes. This ratio is used for writing of goodwill and capital adjustment. Now here what is the formula? For calculation of new ratio, the formula is old ratio multiplied by balance of 1, or by another way you can calculate the new ratio as old ratio minus sacrifice ratio. Generally the first one it is in here 1. Now, what is the balance of 1? When a new partner brings the capital into the partnership for 1/5 share, means his share out of 5 is only 1, means what's remaining? 4/5, that is balance of 1. In mathematical term, we can say 1 minus whatever is there, that is suppose 1/4 is there, 1/5 is there, 1 minus, in our example, 1/5 means what the balance remains 4 upon 5. Is it okay? Now we can take an example how to calculate new ratio. Suppose there are two partners, Mr. M and Mr. G is there. Who shares the profits and losses in the partnership firm 2:3 means their old ratio is 2:3. They admitted Mr. O as a partner in a partnership firm and he brings for 1/4 share. Obviously, now how to calculate new ratio? Therefore, balance of 1 that we have to calculate. Therefore, 1 minus 1/4 balance comes 3 upon 4. 1 minus 1/4 balance comes 3 upon 4. Therefore, we can take one by one. Mr. M. How to calculate a new ratio? That is old ratio multiplied by balance of 1. Old ratio is 2 upon 5. From where the 5 comes? That is 2 plus 3 is equal to 5. Of 5, 2 share is of Mr. M multiplied by balance of 1, that is 3 upon 4. Therefore, here what comes? The LCM. It is how much? 20. Is how much? 20. 5, 4 is 20. 4, 5 is 20. 4, 2 is 8. Is it necessary? No. It is not. Therefore, what to be done? 2 upon 5 multiplied by 3 upon 4. It comes 2 3s are 6, 5 4s are 20. Next, Mr. G. What it comes? That is 3 upon 5 multiplied by 3 upon 4. It comes 3 3s are 9. 9 upon 20. And 1/4 of 20 of new partner. It comes 5. Therefore, new ratio is equal to what? 6:9:5. That is your new ratio. Is it okay? This is called calculation of new ratio. Now we'll have to consider what is the sacrifice ratio. While considering sacrifice ratio is to be calculated as old ratio minus new ratio. Now, old ratio minus new ratio is equal to sacrifice ratio. Therefore, here Mr. M, who is the first part, his old ratio is what? We can take another example, not of this containing. We can have Mr. A, Mr. B, and admitted partner is Mr. C. Am I right? Now, A and B, they going to share the new profit sharing ratio 6:4. That is their old ratio. Whereas new ratio is given in the problem. Suppose 10:6:4. This is your new ratio. Now here what to be done? We'll have to calculate sacrifice ratio. Therefore, sacrifice ratio is equal to old ratio minus new ratio. We can take Mr. A, where our partners are A, B and C. A, old ratio is 6/10 minus new ratio. What is the new ratio? 10:6:4. Therefore, 10 upon 20. 10 upon 20 is equal to LCM comes 20. 10 2s are 20. 20 ones are 20. 2 6 are 12 minus 10 ones are 10. Here comes 12 minus 10, 2 upon 20. Are you with me? We'll have to make the multiplication of this. That here comes 12. About the B, same. Here B's ratio is what? 6. 6 upon what? Old ratio. Not old ratio is this one. Old ratio is what? 4. 4 upon 10 minus 6 upon 20. Is it there? Therefore, 10 2s are 20. 20 ones are 20. Again here 2 4s are 8 minus 6 1s are 6. Therefore 8 minus 6, it comes 2 upon 20. Therefore sacrifice ratio is equal to 2:2. It means that sacrifice ratio is equal to 1:1. They are equal partner in a sacrifice ratio. This is called new ratio, sacrifice ratio, how to calculate old ratio, that everything we have seen here. Now, after the ratio, our next part comes what? Goodwill and calculation of goodwill. Now here, goodwill is what? Goodwill is intangible asset. Goodwill is the benefit, name, fame, reputation, image of business which ultimately help the business to earn profit. Goodwill is calculated on the basis of part performances. There are various methods of valuation of goodwill, but for our 12th standard there are two methods are there, that is average profit method and super profit method. Now what is exactly average profit method? Here the goodwill is calculated on the average basis of the past number of years of profit. It is assumed that the firm will remain average profit for next certain years also, and go the goodwill is calculated on the basis of certain number of years purchase of average profit, certain number of years purchase. Am I right? That is most important. Whereas a super profit method, it is the profit which is earned over and above the normal profit. Whatever your normal profit is there, normal rate of return, that is most important. Every business we must get, it is decided by the businessman, minimum that much amount should receive, that is called a normal profit. If it is above whatever we are going to receive, comes under super profit, beyond the normal profit. If the firm earns extra profit than the normal standard profit, this is because of whatever the may be reason, that is the reputation may be there, the extra efforts of the partners must be there, and so the super profit can be considered as a base for calculation of goodwill. Normal rate of return is considered to calculate the profit normally expected on the capital employed. Suppose I am going to invest in the business 1 lakh. It is there in the year I must receive, suppose what kind of the business I am doing, I must receive 10% every year, means how much? 10,000 I must receive. That is my NRR. If I receive more than that of, that's good. And if suppose it receives less, then better way to stop the business. If the firm earns excess than the normal profit, it is called super profit. This is called the goodwill can be calculated by average profit method and your which one? Super profit method. Now there are certain formulas where decided, it is given, and according to that formula we are going to calculate your what? Average profit and super profit. How it is to be calculated. Now see, here in this case, the calculation of goodwill by average profit method. That is, goodwill is to be calculated as average profit multiplied by number of years purchase. This number of year purchase is given in the problem. We'll have to ascertain average profit. How to calculate the average profit? A formula is given. Student must know the formula very well. It should be by heart. Total profit divided by number of years. How to calculate the total profit? That is, adding profit and deducting any losses given. Suppose 5 years and figures are given. In that, there is 1 year is given which is having a loss. Then add profits of the 4 years and then deduct the loss. Out of the 5, suppose 2 years loss is there and 3 years profit is there. Then take the 3 years profit first, total, and from that 2 years loss should be deducted, and whatever you are getting is called as a total profit divided by number of years. For 5 years, it should be divided by 5. If it is for 4 years, divided by 4, etc., etc. This is called the goodwill is equal to whatever the profit you are going to receive, that is called average profit, that should be multiplied by number of years. Whatever the result you are getting will be called as what? Goodwill for the average profit method. Next one is super profit method. Goodwill is equal to calculated by super profit method. That is, goodwill is equal to super profit multiplied by number of years purchase. Again, it is given in the problem. This figure is available in the problem. Now we'll have to ascertain the super profit. For that purpose, what is the equation for super profit? That is average profit minus normal profit. Just I have explained what is the average profit. Average profit is equal to total profit divided by number of years. Means we'll have to ascertain first average profit. Then you'll have to ascertain normal profit, because the normal profit is to be deducted from average profit to ascertain the super profit, and hence normal profit is equal to capital employed multiplied by NRR divided by number of years. NRR stands for normal rate of return. After getting the figure of average profit, after getting the figure of normal profit, you are going to ascertain super profit, because super profit is equal to average profit minus normal profit. And whenever you get the super profit, you will be in a position to calculate goodwill, that is super profit multiplied by number of years purchase. This is called the calculation of goodwill by different ratio. Now, how to make the adjustments of goodwill given in the problem in our accounting? That is called treatment of goodwill, how it is to be made. Now, in case of treatment of goodwill, we can say here that is treatment of goodwill may be of by two ways. That is first here premium method and another is valuation method. For this year it is there premium method and valuation method. What do you mean by here the premium method? Premium method means when a new partner brings the goodwill in cash or in kind. I told what is kind asset. It may be retained in the business or it can be withdrawn by old partner. That is called premium method. Whereas what is the valuation method? In case of valuation method, new partner does not bring the goodwill. Therefore, the old partners measures the goodwill of the firm and then it is raised in the books of the firm. As per the time to time being it is given in the problem, it will be considered as your normal asset, appreciation and depreciation. Let's see later. Now, whenever we are going to consider treatment of goodwill, the word treatment of goodwill considers here, that is how it is accounted for. Whenever the new partner brings the amount of the goodwill into the cash, am I right? Your entry will be cash or bank account debit to goodwill account. What is the entry? Cash or bank account debit to goodwill account, and second entry will be goodwill account debit to old partners capital or current account, that is in the sacrifice ratio. If the accounts are opened as per the fixed capital method, then we are going to open the current account and that's why you return current account. What are the two main entries are there to be passed? That is when a new partner brings his share of goodwill into the cash and retained in the business, what entry we are going to pass? Cash or bank account debit, because that comes in, debit what comes in, to goodwill account, and secondary goodwill account debit to all partners capital oblique current account, whatever may be the case. We'll have to write the narration for every journal entry. Always keep in mind. Now, suppose when the new partner brings his share of goodwill into the cash and it is withdrawn by the old partner, means first he brings into the cash into the business as a goodwill and keeping that goodwill into the business. Two entries we have seen. Second, when he brings the amount of the goodwill into the cash and it is withdrawn by old partners. Now there are three entries for this. As usual, first cash account debit to goodwill account, cash or bank account debit to goodwill account. Second, goodwill account debit to old partners capital account in their sacrifice ratio. And it is withdrawn, it is taken over by the old partners. Therefore, old partners capital account debit to cash or bank account, where the old partners capital account is debited as per their actual withdrawn. How much it is withdrawn, that is how much we have given first in the sacrifice ratio. That suppose sometimes 50% is withdrawn and sometimes 1/4 is withdrawn or it is fully withdrawn. Accordingly that the entry will have to write the amount in the old partner's capital account. Third part here in the premium method is that when the new partner brings his share of goodwill into the cash and it is paid to the old partners, the most important word privately. When the word privately used means it doesn't appear in the books of account and hence there is no entry for this transaction. ये on the book नहीं आता है, of the book है, that's why there is no entry for this transaction. After this, whenever we are going to consider treatment, after this we are going to start with the valuation method. These three entries will be there for your what we can say premium method. And now valuation method is when the new partner also does not bring his share of goodwill in cash and it is raised in the books of the firm. He doesn't bring into the cash. Then what happened? It is raised in the books of the firm. Whenever the goodwill is raised, goodwill account debit, goodwill is asset. Assets are always having debit balance. Rising means increased value of the goodwill. Therefore, goodwill account debit to old partners, capital or current account, and in their which ratio? Old ratio. That is most important. But when you raises the goodwill, in this case, the goodwill will appear in the new balance sheet of to where asset side. When the new partner doesn't bring the share of goodwill into the cash, but it is raised in the books of the firm. Only one entry, goodwill account debit to old partners' capital or current account in their old ratio, and the goodwill will appear in the balance sheet asset side, that is new balance sheet asset side. Last entry is when goodwill is raised and written off. Whenever it is written off, it means that it is not going to appear in the balance sheet. Which balance sheet? New balance sheet, that is the balance sheet which we are prepared after admission of partner. Therefore, whenever it is raised, your entry remains as it is. Goodwill account debit to old partners capital oblique current account, that is their old ratio, and it is withdrawn. Withdrawn means all partners capital account debit, including new partner. All, that word is most important. All partners capital account debit in which ratio? New ratio to goodwill account. Here goodwill is debited, your goodwill is credited, hence it doesn't appear in the books of account. These are the entries for the goodwill. When goodwill already appears in the books of the firm, suppose it is normal asset, goodwill is there, then it will be accounted as normal asset. That is, it goes to the either in case of depreciation goes to the revaluation account debit side, or to the partner's capital current or capital account, and in case of appreciation goes to the credit side, either of these two accounts. This is called your treatment of goodwill, isn't it? Now next we'll have to consider what is the accounting, how the preparation of accounts, what accounts we are going to prepare while solving the problem. The account which we are going to prepare here in case of admission of partner is first revaluation account or profit and loss adjustment account. Now, what is the meaning of revaluation account? Revaluation means whenever the new partner is admitted, all assets and liabilities, whatever necessary, they are to be what we can say revaluated. Valuation is made among these assets. Either there are two are there, that is appreciation, that is increase in the value of the asset, depreciation, that is decrease in the value of the asset. Appreciation means it is appreciated, means value increases, and here depreciated means value decreases. Whenever it is appreciated, it goes to the credit side of the revaluation account. Whether it is depreciated, it goes to the debit side of the revaluation account. Means what to be done? You will be given the balance sheet and certain adjustments. When it is given that so and so assets were revalued, their values are decreased, they are depreciated. Means we'll have to prepare the accounts, that is revaluation account, partners capital or current account, balance sheet. Then this cash or bank account and goodwill account, these two accounts are there. Sometimes it is not asked, but for our understanding purpose, it is necessary to prepare this account as your working note. Prepare the working note and prepare these two account, cash or bank account and goodwill account. And then you have to prepare the working note of new profit sharing ratio and sacrifice ratio. 4 working notes are compulsory to prepare. Now, whenever the assets are depreciated, then go to the new balance sheet, take the balance sheet figure of the asset. Suppose it is given plant and machinery is given 1 lakh rupees. It is depreciated by 10%. It is your balance sheet asset side, new balance sheet asset side. Then you have to write less depreciation dash 10,000. 10% comes 10,000. Write the figure outer column 90,000, and this 10,000 will go to a revaluation account debit side, which is also known as profit and loss adjustment account. And whatever the appreciation is there, that goes to the where profit and loss adjustment or revaluation account, which side? Credit side. You have to make all these adjustments. Any cash is given to anybody else or whatever things are there. Then towards the capital account, you'll have to write the capital balances, transfer the general reserve, whatever is there to the partner's capital account credit side in their old profit sharing ratio. Then whatever the profit and loss balances are there, that is also to be transferred. In case of liability side, it is there, that is credit balance, that to be given to the partner's capital account credit side. If it is appearing to the balance sheet asset side, then it is to be debited to the partner's capital or current account. In case of fixed capital method, directly write the capital balances to the new balance sheet as liability side, whereas open the current account and make all these adjustments to the partner's current account only. Now, if suppose nothing is given regarding the any asset or liability, suppose sundry creditors are there and nothing is given regarding the sundry creditors, then we'll have to write as it is. Don't forget, we'll have to write as it is. Then afterwards, after making an all goodwill and all these adjustments, first close the goodwill account, which automatically going to be tallied. Then close the cash or bank account, transfer the cash or bank balance to the balance sheet asset side. Generally, it is forgotten. You will have to transfer this balance to where balance sheet asset side. Then close the revaluation account. Then find out the profit or loss. Whatever the generally profit is there, is that profit is to be, or losses may be also there, but generally profit will consider that to be transferred to the old partners in their old PSR. Then after transferring this, close the partners capital or current account and transfer the balance to the balance sheet liability side. Take the total of liability, take the total of asset, and both should tally with each other. Then only your problem will be considered as tallied problem. I have given basic information about the admission of a partner. In detail, you will have to go for that as per your book and solve the problems for the admission of partner. And if you find any difficulty, please make the comment and please like, share and subscribe for more videos. Thanking you. All the best everyone and goodbye.